Summer home buying season is here, and if you're thinking about waiting until next year to buy a home, this video could save you a lot of money. Right now, many buyers are sitting on the sidelines and they're hoping interest rates are going to come down, or they might be waiting for some massive housing crash. But what a lot of people don't realize is this: if rates come down in 2026, there's a very good chance more buyers will jump back into the market at the same exact time. And when more buyers come back into the market, the whole supply and demand equation kicks in. More buyers, more demand, prices go up. Competition gets stronger and tougher, and bidding wars could come back. Believe it or not, waiting could actually make buying a home a lot more expensive and not less expensive, which is counterintuitive to what you think. In this video, we're breaking down why buying this summer may actually put you in a much stronger financial position long term, how appreciation and equity really work, and why trying to time the market is one of the common mistakes buyers make. First, let's talk about rates. Rates fluctuate every day throughout the day. The lowest rate of 2026 was 5.98% on February 26th, according to Freddie Mac. Highest was 6.6% April 2nd, according to Freddie Mac. So currently, when we look up interest rates, and again, they change every day throughout the day, they're like mid-sixes-ish. That's the easiest way to say it. Now, are there variables that impact that rate? Absolutely. And that's going to be the occupancy. So whether it's a primary residence, a second home, an investment property, the loan type, the credit score, all of that will impact interest rates. So for this purpose, I'm just talking mid rates right around that 6.5% interest rate. And it really is all about supply and demand. So when interest rates went under 6 earlier this year, watch out. I mean, mortgage applications were up, activity was up, people were out, they were going after it. And this all does impact the cost of housing. Why? Because as a seller, if there is more demand, you do not have to negotiate as much. As a seller, you might be taking more buyer offers in and evaluating and choosing the buyer based on the offer. You might be in a better negotiating position because, again, the demand is there and there are more buyers. So this supply and demand equation really does impact the real estate market, and it can impact it as much or more than the actual interest rate. A little perspective. In 2020, when mortgage rates dropped, and so in that 2020 to 2021 market cycle, yes, interest rates dropped. They dropped to the lowest point that I had seen in my career. And by that, I would say they were on average in the 3s. So 30-year fixed rate type of scenario. Market activity was insane. And we had so many people, because of the demand, because buyers were out, they wanted to take advantage of that low interest rate. They couldn't get under contract. They would write 10, 15, 20 offers. And at that point in time, it was a seller's market, which meant that sellers did not have to negotiate terms, that in many cases, buyers were paying above list price and market price because a lot of those homes didn't appraise for the sales price, which meant the buyer was having to come out of pocket to bridge the gap between the ultimate sales price and what the house appraised for. So again, this is just a really good example of how supply and demand truly impacts the cost of housing and can impact your ability to get under contract, your ability to negotiate. Right now, it's kind of a sweet spot because depending on the market across the country, and they all vary, state, county, city, specific subdivisions, but depending on the market you're interested in purchasing in, you may see that it's a seller's market. So they're going to negotiate less. You may not get a price reduction. You may not be able to negotiate closing cost credit or additional terms like maybe a contingent offer. Maybe you have a house to sell. So sellers in those types of markets are less likely to work with you. Move over to the equation, and now it's a buyer's market. Again, when it's a buyer's market, buyers have more negotiating opportunity. Not on every house and not in every subdivision or city across the country, but in those markets, you're going to see sellers more willing to work with you. Maybe it's working with you on a closing date. Maybe it's working with you on the price or something else that's going on in your world that's really going to help bring that deal together. So this whole seller's market, buyer's market, it really will have an impact on your true cost of purchasing that home. So I'm in the Phoenix metro area, and buyers can still negotiate price cuts and seller concessions in some of the areas. For example, Phoenix metro, 53% of the closings in April 2026 had some type of seller concession, according to ARMLS. However, Phoenix metro April 2026 saw 13.5% fewer price reductions than April of last year, according to ARMLS. So that's already giving you a real indicator that buyers are coming back, sellers are needing to negotiate less, and the trend is coming down, meaning that less sellers are having to contribute or contribute at the level that they were contributing with regard to price reductions, closing costs, etc. Why waiting can cost you more? If rates improve, demand rises. More demand can push home prices higher. Higher prices can outweigh savings from lower interest rates. That's just the truth. So we haven't even talked about the wealth building component. We've been talking market cycles, interest rate, and the cost of acquiring the home relative to those types of markets. But let's talk about equity. What is equity? I know that a lot of people talk about building wealth through real estate. I talk about that, but it's really important to understand what the heck that equity is. So here's how it looks. If you were to buy a $400,000 house today and you did 10% down on that house and you financed $360,000, then you have $40,000 in equity. And every month you pay your payment, you're paying towards your principal, which means your loan balance is going down and the equity that you have in that home is increasing. Now let's think about that and combine it with appreciation. Appreciation is where that $400,000 home, maybe year over year, it's appreciating, which means that it's more expensive. The market value is going up. So let's say that a very conservative annual appreciation rate would be 2%. I mean, 2%, which means 2% on $400,000 over that first year now puts your home value at $408,000. So now your equity is the difference between the market value and your loan balance. And then the next year, let's say that the interest rates do drop and buyers come back even full force and the demand goes up and we really start to see that that real estate market is starting to move fast. You're going to see that now that market value of your home is increasing because, again, the market value, that appreciation is driven by comparables in your neighborhood, and it's going to make your home worth more. So let's say year two, now your $408,000 market value is worth 5% more, and so now you're going to see that that 5% market value or appreciation rate is increasing that market value, which again gives you more equity to work with. That's how people build wealth through real estate. And I know that it's a little confusing, especially if you're a first-time home buyer, but that's just the way that the math works. So for example, I have a really good friend and she has been talking about buying a home for years, probably way too many years. And we just had a conversation today where she found the house that she ultimately loved. It was in a great area, a great school district, and that house was $412,000 8 years ago. Well, guess what? That house today, she went and checked on it, is over $800,000 in market value. Had she bought it 8 years ago, that $400,000, that would be her equity. That shows you the appreciation that that home, that one home had over that 8-year period. That's life-changing. But instead, she chose to rent. So she's paid over $350,000 in rent over that 8-year period. That's a really great example of just this look back. And, I get it. Like sometimes you're just like, I can't afford to buy a house. Maybe that's the case. Maybe that's not the case. And that's really where it's just so important to talk to a strategic mortgage advisor, whether that's here at Cornerstone Home Lending or the KellyZitlowGroup or another lender. It's just so important to talk through your scenario, figure out how you can do that. Maybe you need a co-signer. Maybe you need to talk with your parents or a relative. Maybe somebody can gift you your down payment. But honestly, if there's a will, there's a way. And I asked her specifically, knowing what you know now, what would you tell yourself if you could go back in time? And she said, I would change the story that I was telling myself because at that point in time, I didn't think I could afford it and I never talked to a lender. So that's a good takeaway here. And I'm not trying to convince you. I just want you to really understand that the true number where if you own a home, homeowners truly do have a greater net worth than somebody that rents. And there's pros and cons to it all, right? If you rent, hey, then you can just get up and move year over year if that's what you want to do. But if you're looking for that longer term investment, real estate is where it's at. At the end of the day, real estate isn't about timing the market. It's about time in the market. The sooner you buy, the sooner you start building equity, creating that long-term wealth and benefiting from appreciation year over year. Because here's the reality. You can refinance it to a lower interest rate later, but you can't go back and buy at yesterday's prices. And if rates do drop in 2026, like people are predicting, there's a very good chance competition increases and price increases at that point in time. That's why the smartest buyers aren't just waiting for the perfect market conditions. They're making strategic decisions based on their own financial readiness and long-term goals. We'd love to help you run the numbers and explore your options and create a strategy that makes sense for you and your future. Again, you can call or text 480-725-0150 or schedule a call in the link below.